Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Palantir stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 35 billion market cap. They're trading at $16 a share and they have 2.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So their free cash flow looks pretty good. It goes from negative 300 million to the highest ever, 375 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And it looks like they have lots of write-downs because they have negatives every year. But it is improving. It was negative 1.2 billion in 2020. And now it's a small negative, negative 43 million in the trailing 12 months. Revenue is a sales for the company, and that looks pretty good. It doubles from 1.1 billion to a little over 2 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 29 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $24 billion. We divide that by 2.1 billion shares. And we get a calculated stock price of $11. They're trading at $16. So they're trading at a 43% premium. It's a strong sell according to the model. So it does seem like they're still overvalued. But there could be massive growth with this company in the next few years. As you know, the stock price is not based off of how much money the company makes. It's based off of supply and demand of the market. Even if the company makes a ton of money and people sell the stock, the price goes down, and vice versa. So it's market perception. There are 141 companies in the same industry as Palantir, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 30 million, more than the median, less than the average. Microsoft spends a ton in CapEx, 28 billion. They don't use much debt. Their debt to equity ratio is 0.1. For every dollar of equity, they have 10 cents of debt. They generate a lot less free cash flow than the average company. They rank 9th in market cap. Their price to book is between the median and average. They're at 14. Median is 3, average is 30. We can't look at their PE since they have negative earnings. Price to free cash flow, it's pretty close to the average, a lot worse than the median. And their price to sales is worse than the median average. They generate 2 billion of revenue, which isn't that much for the size of the company, but they are growing. And we can't look at their 5-year annual revenue growth rate. We don't have that much information because they haven't been publicly traded for 5 years. They released earnings last night and the stock is down quite a bit, I think about 8%. I'm doing this video on Tuesday morning. They missed on revenue and missed on earnings. But they came pretty close. They were within 1% of both. Last quarter, they did beat earnings and revenue. Same with the quarter before that. We'll go through their financials and their 10Q in a little bit. But let's look at their second quarter highlights. Net income of $28 million. Not a lot of net income, but it's positive, which is a big sign. That's their third consecutive quarter of profitability. Operating income of 10 million, that's a 2% operating margin. A pretty low margin, but they'll grow into that number and improve it a lot. Their EPS is 1 penny. Revenue is up 13% year over year. It's 533 million. I think that's their highest revenue ever for a quarter. Commercial revenue grew 10%, government 15%. I think that's the future with this company, government revenue. Customer count grew 38%. They currently have 161 US commercial customers, operating cash flow of 90 million, free cash flow of 96 million, and they have a little over 3 billion of cash on their balance sheet. Let's take a look at their 10Q. This is their income statement. This is the second quarter of 2023, second quarter of 2022, first half of 2023, first half of 2022. Revenue is up from 470 million to 533 million. Let's see if they give a breakdown of this revenue so we know what it is. Of the 533 million of revenue, 300 million is government, 230 million is commercial. Government is the best revenue because the US has deep pockets. Here's a different breakdown of their revenue. 328 million is in the US, that's 62% of their revenue. 63 million in the UK, 12%, and the rest of the world 140 million, 26%. No other country represents more than 10% of its revenue. So this 140 million of revenue is spread across multiple countries. And it's also good to see their revenue is up in each location when you compare it to the second quarter of 2022. All the expenses directly related to generating the revenue are 107 million. Most of that is payroll. Revenue minus cost of revenue gives you the gross profit, 426 million, up from 370 million. For the first half of 2023, it's 844 million. They spent 180 million on marketing. Here's some more detail on their marketing expenses. Their marketing went up 9% when you compare it to the second quarter of 2022. It went up 15 million. The increase in marketing was mainly payroll and travel. R&D of 100 million compared to 88 million. That went up 13%. The increase in R&D is from payroll, also 5 million in third-party cloud hosting services. G&A of 133 million, that's down 15% from last year. The decrease is from stock-based compensation expenses as well as professional services. That was offset by a $5 million increase in payroll. Let's go back to their income statement. 416 million of operating expenses. So they have positive operating income of 10 million. Last year, they had an operating loss of 41 million. In the first quarter of 2023, they had positive 4 million of operating income. So for the first half of 2023, it's positive 14 million. They received lots of interest income, 30 million. Last year, it was only 1.5 million. Let's see if we can figure out what the 30 million represents. The increase in interest income was due to higher interest rates. Also an increase in their cash and US Treasury securities. They spent 1.3 million of interest on their debt. That's about double last year. So for the quarter, they had a net profit of 28 million. Last year was a net loss of 179 million. So their EPS is 1 penny. And they did increase their shares outstanding. Last year they had 2.05 billion. Now they have 2.13 billion. But they did announce a $1 billion stock buyback today. That doesn't mean they bought back 1 billion of their own stock. That just means their board approved a buyback, which they may do sometime in the future. Let's look at their balance sheet. 3.6 billion of current assets, 680 million of current liabilities. So their current ratio is about a 5. They can cover their current liabilities with their current assets 5 times. They have over 3 billion of cash, 375 million of accounts receivables. This is how much money other companies owe them for selling on credit. For the quarter, their revenue was a little over 500 million. So much accounts receivables for such little revenue. Can't the government just pay on time? So their total assets are 4 billion, up from last year of 3.5 billion. Let's look at their liability section. Accrued liabilities. These are expenses they've incurred but haven't paid yet. They give a breakdown of the accrued liabilities. 68 million of payroll, 39 million of accrued taxes, and 77 million of other. 260 million of deferred revenue. This is when one of their customers makes an advance payment for a product or service Palantir will deliver in the future. 184 million of customer deposits. So it does look like lots of customers prepay for items, which helps with cash flow. It looks like they lease assets from other companies. They owe 190 million on those leases. So total liability is 945 million, up from 818 million. Let's look at their equity section. They raised 9 billion from selling stock, and they lost 5.8 billion from running their business. So they have 3 billion of equity. Equity is assets minus liabilities. Or another way, equity plus liabilities, which is roughly 4 billion, equals assets. Let's look at their statement of cash flows. This is for the first 6 months of the year. So it's the first and second quarter of 2023. The first section of the statement of cash flows is operating cash flow, and they generate 278 million of cash flow. You see, deferred revenue really helps. They had a cash inflow of 115 million in deferred revenue. Last year, they had a cash outflow of 12 million in deferred revenue. The way deferred revenue is negative is when they move it off their balance sheet and onto the income statement. They have to minus it out. But when the customer prepays for items, it's a cash inflow and it's put onto the balance sheet. They only spent $8.7 million in PP&E. Last year, $21 million. In their financing section, they had a cash inflow of $116 million. These are proceeds from their employees exercising stock options. If you put $10,000 into the company when they started trading back at the end of 2020, just after a few months, you would have been close to $35,000. Then the stock came crashing down. It was below its IPO price for about a year. It has been coming up the past few months. So your $10,000 would be $19,000 today, which is a good return. It's a 25% annual return, a 90% total return. Let's take a look at the company on Simply Wall Street. Its last price was $18, 38 billion market cap, down 9% this week, up 83% for the year. Let's learn a little more about the company. They build software for the US government to help in counterterrorism. One of their products is Palantir Gotham, a software platform which enables users to identify patterns hidden deep within datasets. This provides signals and reporting from confidential informants. Pretty top secret stuff. This helps users of the platform plan and respond to threats. They also have Palantir Foundry. It's a platform that transforms the way organizations operate by creating a central operating system for their data. And it also allows individual users to integrate and analyze the data all in one place. Their other product is Palantir Apollo. This enables customers to deploy their own software virtually in any environment. The company was founded 20 years ago in 2003, based in Denver, Colorado. A couple of risks. Shareholders have been diluted in the past year. Volatile share price. It looks like the stock started trading in October 2020. Then after 3 months, it hit its peak, $36. It never got that high again. From January 2021 to May 2022, it fell over 80% to below $8. It got even lower by the end of 2022, falling to around $6. But that's its lowest point, $6.35. It was up almost 200% before today's crash. Simply Wall Street's valuation is $27. They say it's 34% undervalued. 14 analysts priced this stock at $13. They say it's 30% overvalued. So it looks like the analysts are more in line with me. Simply Wall Street is usually a lot higher than other people. Their revenue in 2018 was $600 million, $740 million the following year. Then it hit $1.1 billion for 2020, up about 50% to $1.5 billion in 2021. It's a little over $2 billion for the trailing 12 months. Simply Wall Street didn't add the second quarter of 2023. Their data is up to March 30th. In March 30th, they were a little under $2 billion. Now they're a little over $2 billion. Their revenue forecast for 2023 is $2.2 billion. Next year, $2.6 billion. And for 2025, $3.2 billion. They had $400 million of debt in 2019, but they paid that down. They have no debt currently. And you can see their equity balance has gone up a lot. It was $500 million in 2018. Now it's $2.8 billion. Most of their equity is cash, money they raised from selling stock, because they're not profitable yet. The CEO's salary is $1.1 million, total compensation $5.5 million. He's been with the company since the beginning, nearly 21 years. The co-founder of PayPal, Peter Thiel, is the co-founder and chairman of this company. Only one insider trade in the past year, a sell for 4,600 shares. 51% of the company is owned by the general public, 35% by institutions, 11% by insiders, and 4% by public companies. Their biggest shareholder is Vanguard at 7.75%. Peter Thiel is the second biggest shareholder at 7%. The CEO is 2.6%. ARK Investment Management, Kathy Wood's company, owns 0.3%. Their employee count has gone up a little bit over the years. It was 2,400 in 2019. They're currently at 3,900. The ticker trades on the Wiener Bourse, London Stock Exchange, New York Stock Exchange, Deutsche Börse, Zitra, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.